Have you ever found yourself in a situation where you owe taxes but simply cannot afford to pay the full amount right away? If so, you might be wondering how the Internal Revenue Service decides what your monthly payment should be on an installment agreement. The good news is that the Internal Revenue Service does not just pull a number out of thin air. Instead, they consider a comprehensive picture of your financial situation to determine a fair and manageable payment amount. The primary driver behind your monthly payment is your ability to pay. The Internal Revenue Service wants to establish a payment plan that you can realistically maintain without facing undue financial hardship. They carefully analyze your income, your necessary living expenses, and the value of your assets to arrive at what they call your reasonable collection potential. This approach ensures that the payment is both achievable for you and satisfactory for the government. To accurately assess your ability to pay, the Internal Revenue Service typically requires you to submit detailed financial information. This is often done using a form called a Collection Information Statement, which can be Form 433A for individuals or Form 433F for shorter agreements. On this form, you will report your gross monthly income, your bank account balances, investments, real estate, vehicles, and all of your monthly expenses. It is crucial to be thorough and accurate when providing this information, as it directly impacts their decision. The Internal Revenue Service uses established national and local standards for certain living expenses, such as food, clothing, housing, utilities, and transportation. These standards help them determine what constitutes a necessary expense, rather than simply accepting any amount you list. After subtracting these allowable living expenses from your net monthly income, the remaining amount is generally considered your disposable income. This disposable income forms the basis for your monthly installment agreement payment. For example, if your net income is $2,500 and your allowable expenses are $2,000, your payment might be around $500 per month. It is also important to understand the different types of payment plans available. A short-term payment plan gives you up to 180 days to pay your tax liability in full, but interest and penalties still apply. An installment agreement, on the other hand, allows you to make monthly payments for up to 72 months. While an installment agreement is being negotiated and active, the Internal Revenue Service generally will not take enforced collection actions like levying bank accounts or garnishing wages, as long as you keep up with the agreed-upon payments and file all future tax returns on time. Understanding these factors empowers you to approach the Internal Revenue Service with confidence. By accurately presenting your financial situation and knowing how your ability to pay is calculated, you can work towards an installment agreement that helps you resolve your tax obligations responsibly and move forward with peace of mind.